Joining me to discuss PPAC Private Wealth Management, their managing principal, David Dietz, SureVest CEO, Rob Luna, and Kingsview Wealth Management CIO, Scott Martin. And the crypto bros, I did not get the memo. I'm wearing the wrong shade right now. I should have had my hue. You guys didn't tell me. All right, let's start with this, guys. I'm going to talk about steadfast rules for buying stocks that are down in down markets, because people, obviously, this is what you want to do. We want to go into next year and take advantage of the carnage, but this year, any attempt to do that mostly has been a mistake. Rob, what are your steadfast rules?
Well, look, I mean, at the end of the day, Charles, you've got to buy quality over the long run. And if you look at stocks over the long run, you get 9 to 10% returns. Why is it not 2 or 3% like CDs? Is because you have to endure years like this, and that's the volatility. Stick with quality. You just talked about retail. Wayfair, that's a stock hasn't been doing well. A company like Restoration Hardware, though, they are dominating. Great products, great service, great company. When you get a chance like this to buy those names down 50 or 60%, that's when you step up and do it. Don't start digging through the rubble, trying to find the heavily most shorted, hoping you're going to get some lottery tickets. Stick with high quality, stick with themes that you can have conviction in during these hard times.
Scott?
Yeah, I agree on the buy the dips sentiment, Charles. The problem is, in a market like this, you have to sell the pop. And so to Rob's point, staying active and not hoping for that lottery ticket, but being happy with saying, hey, I'm going to get 20, 25, 30% out of a name after it's been downtrodden, like a lot of these names have, is still a win and something you can build on going forward when the market does recover and operate more normally.
David, your approach to this, I mean, you've been buying here and there, I know, throughout the year. What are some of your rules that people should understand if they're going to do this? Because I think obviously if you buy the right names going into 2023, early 2023, you're going to make a lot of money.
Yeah, absolutely, Charles. So here's 3 things that we're looking for here. Companies that have the guts and the willingness to cut costs. So, for example, we heard from FedEx earlier this week that basically they've had a tough year. They had mixed results, but they outlined $1 billion in cost cuts. The stock is up. Another thing we're looking for here is companies that have an opportunity for financial engineering. An example that I'm looking for going forward here is Disney. They may want to spin out the ESPN. That would allow ESPN to get a tie-in with gaming, which image conscious Disney doesn't really want. That, I think, is going to boost the stock. And the other thing, of course, that we're looking for is companies to have lower debt. We saw some weakness in the REITs because they got to roll over some big debt. We've got a higher interest rate regime. So watch your debt levels in your companies.
Right. And by the way, folks, financial engineering, this week we saw FedEx say they were going to cut $3.7 billion out, a euphemism for mostly firing people. But if companies have to find ways of lowering costs, and that's one, to David's point, that might work out. I want to talk about the market overall. Obviously, all eyes are on the Fed, right? So let's put that aside, because I actually think it's going to be earnings surprises that create the big moves. In fact, since the end of the official earnings season, since earnings never stop, 248 names have posted results, 72% have been on revenue, 74% have been on earnings. So the kicker, the average gain for that day, 2.26%. Scott, I think this is the template going into next year. I'm curious as to what you think will be one of the movers for the market, other than the Fed, that can maybe spark a turnaround.
Yeah, I agree, Charles. I think the boat's getting loaded to the other side on the earnings picture with respect to folks expecting negative numbers, obviously misses, not beats, and therefore stocks are already correcting because of that. But those that deliver well obviously do well as far as the next day or two that they trade. So, look, for us, I think it still is the Fed first and foremost. But look at some of the consumer numbers, Charles, that are coming out as far as confidence, retail sales. Those are numbers that can start to support earnings going forward if we're worried about earnings coming down, as many folks are talking about.
David?
Yeah, so we're really looking at inflation and interest rates. You know, at the end of the day, the Fed doesn't call the economy. The economy is ultimately going to call the Fed, and they admit that. They say they're data dependent. So we're looking at these inflation numbers continuing to come down. We're looking at the interest rate. If inflation is going to be such a big problem, why is the 10-year well below 4% after cresting over 4%? I think ultimately the Fed realizes that. We get more stabilization in that bond market, and stocks will follow.
Rob?
Yeah, I mean, I actually agree with both David and Scott. I think they made some great points. And look, it is all about the Fed right now. But if you look at oil prices, if you look at housing starts, it's hard to believe that we don't have peak inflation right now. I think we actually put the bottom in the market already. We're really just chopping around right here. If we can get anything constructive out of the Fed at all, watch out. I think this market's getting poised to rally.
Hey, guys, real quick, I started this segment off talking. There are two names I think that are going to be imperative with the broader growth area, Apple and Tesla. Anyone buying any of those names right now? David Dietz, okay.
Charles, I mean, I'm going with Apple here. You see this little thing? I can't get rid of it. This is the stickiest device on the planet. And they've got this walled garden of all these various apps and services and watches and so forth that just keeps you stuck there. So they've got this long, a lot of revenues from people like me upgrading the emerging world. And I think ultimately China's going to settle down, which is going to solve some of the supply disruption. Apple's pulled back about 25% this year. It's worse than the S&P 500. Here's your opportunity.
Rob, what are you buying?
Yeah, I'm not going with either of those two. Not that they're not going to have good years next year. I think they have a good chance, but they haven't been beaten up enough. Amazon, Google have been down over 50%. Names I like, though, Disney, great comeback story right here. The name I've talked about here for the last month, a victim of tax law selling. If you're looking for one name, I think you can easily double next year. Farfetch, FTCH, under $4. That stock could actually be bought out by Amazon. A lot of opportunity, a lot of overhead. If you're willing to take on a little bit of risk, I think that could be your biggest mover next year.
Scott, we got a 100% mover there, my man. Can you beat that?
I think so, man. Cleveland Cliffs, great valuation, good top-line growth, and a lot of demand coming back for them in 2023. This stock has been forgotten. You got to own it.
All right. David, Scott, Rob, you are three of the best. I appreciate you. Have a fantastic Christmas, and let's rock and roll again next time we see each other, maybe in 2023. Thanks a lot.
Thanks, Charles.
Thank you.
By the way, folks, everyone, to get a chance, go to wstreet.com. What I just laid out here at the top of the show is just a small part of a much larger special report. I'm going to release it on January 6th. Make sure you see it. Prepare your portfolio. Next year should be a much better year. Well, just moments ago...